In this video, guys, we're going to look at loss aversion. Stay tuned. Hey traders, a very warm welcome to you. So loss aversion, and then we're going to get on to myopic loss aversion, what it is and how we can avoid it. Okay, so if we look at loss aversion, generally speaking, for the majority of people, which is why trading can be so hard, because as human beings we're not really set out to be traders, but the pain of loss is a stronger emotion than the joy of gain. And they've done multiple studies on this where they've kind of had people in labs doing it, they've questioned people in the street, but generally speaking, that is the actual way that people are wired. They do not want to lose, especially when it comes to money. So they would rather not lose money than gain money, which is why you have this situation where people are very, very keen to grab profits, right? As opposed to cut losses short. They don't want to lose, so they don't want to cut the loss because they don't want to crystallize that, and they hold on to it, and you know, ultimately it gets worse and worse and worse from a trading perspective, and they cut it eventually just out of sheer fear and sheer panic. So the urge to avoid that loss ends up being a bigger loss, and it's the same with kind of gains. They want that kind of dopamine hit, if you like, of taking the gain. And so this loss aversion thing comes into investing as well, and the urge to avoid losses is often detrimental. There's actually a study that basically investing £1,000 in the FTSE 250 in 1987, 1988, and leaving it for a full 30 years gave you like a £25,000 pot. So it's a massive return on £1,000. But if you traded it in and out and you missed just the best 30 days of that market, so the days when it's better, you would have only had £6,900 around that sort of money. That's a massive difference. So yes, I guess it's a kind of an unusual example, but the point is that is a result. If you're trying to trade in and out and you're kind of taking your money out when the times are bad, you're missing those days when it's good, and just 30 of them over 30 years, so say one a year, one of the best days a year, then you've massively reduced your upside. And so the key is to, you know, as traders, we kind of want to avoid losses, and investors, we kind of want to avoid losses. That's the urge we have, and we need to put steps in place to combat that. We need to be not too risk averse, but at the same time we need to manage our risk. So a plan of action is really what it's about. So if we look at investing, let's say the market's drawing down and we kind of go, you know, I need to come out, I don't want to lose anything, and the market goes lower and then it comes back up. We end up not being in for the point and it's a gain, when in reality, you know, if we're investing over a certain period of time, we need to say, okay, we're not that risk averse. We know that over the amount of time, if it's just a blip and a bear market, we'll be back and we'll be in a bull run multiple years down the line and we'll make some money. And so it's having the kind of feeling of, you know, the Warren Buffett approach, if you like, of, hey, you know what, risk is risk. I'm risk seeking. I'm prepared to risk this amount of money. I'm not avoiding loss. I'm happy to take loss if it's there and I need to take it. I'm happy to take drawdown. I'm happy to be involved in it because I know that over time this is right. And it's having a kind of solid strategy and a solid plan. And myopic loss aversion, which is kind of the big kind of hole that you can dig yourself into, is the more you look, the worse it gets, right? And this is kind of a double kind of whammy for us, if you like, because as traders and investors, we tend to overlook at our portfolios, overlook at the P&L, overanalyze and overassess, constantly looking at your portfolio, constantly looking at your positions, especially if you're in a loss, right? So it's losing, it's not doing so well, and you've constantly got it up. You're checking in the morning, checking in the evening. If you're a trader, you're checking it all the time. And that happens is that's one kind of thing that we head to when we're kind of under the cosh, if you like. But then the worst thing is, the more we look, the worse it gets, because we start playing in our minds, well, it's get way worse. It's already horrible, but it could get worse than this. I could lose more than this. And you kind of run this story through your mind of how bad it could get. Whereas in reality, there's two things that you need to be doing here. One is taking charge of the situation and saying, okay, my plan was to stay in for this, it's drawn down this, I'm out. Or my plan was to invest this for 6, 5 years, whatever it is. I knew that it wasn't going to be plain sailing. I knew that it was a good potential chance of there being a drawdown. So I need to just deal with it and not be irrational, because this is what kind of shakes people out. Now, am I saying stay in and lose more than you intended to do? No, of course not. If your plan was to come out, you must stick with that. But if your plan is to invest in something and it's not quite going that right now for this year, and you've got a kind of 5, 6, 7, 10-year view on it, it's the way it's going to be. And that might even be that you've had X amount of upside and it's drawing down now. And from an investment perspective, just getting involved in these short-term, inverted commas, kind of market swings isn't the most profitable. As we saw with that example, where if you left £1,000 in from 1987 for 30 years, you get 25 grand. And if you missed, then you're kind of trying to time it, you missed those 30 days, you're only left with 7 or 6,800. So it's worth bearing in mind. Like I say, do you have to sit there and sit through catastrophic loss? No. If you've got a plan of action to come out and go back in, then by all means, stick to that. But the point is one or the other. Stick to the plan. Don't just trade for emotion. Say, hey, this is where I was going to come out and coming out, or I'm going to hold it no matter what. I've agreed to hold it. That's my risk capital. I'm happy to hold it. I know that this may happen, and sort of shrug your shoulders and go, what will be, what will be, will be. And don't look at the portfolio every single day, because we all can be guilty of that. All right, guys, take care. Whatever you're doing, see you next one. Bye-bye.